Right, there we go. Yes, so this afternoon we're going to have a good look through the EdgeStat Pro website. And obviously we will look at the statistics, do a little bit of trading on the US indices, and that sort of stuff. Let me just quickly refresh that. I'm just recoding an indicator at the minute. I'm trying to amalgamate a load of my indicators into one, just to make them just more user-friendly, basically, and cut down the amount of indicators I have in total. So just had AI doing that for me. So bear with me, a bit of a mess at the minute. Who's in here? Michael? Anybody else? No, that's it for the minute. Right. So if you were there, I don't know if you were there this morning, but in the live stream this morning, I
was, yeah.
Yeah, you were there. Yeah.
Yep.
I went through this website, EdgeStat Pro, that Nix, my AI, has been creating for me. Well, not for me, just basically in general. And just went through a brief overview of what it does, how it was built, etc., etc. So what I wanted to do this afternoon is just go through it in a bit more detail. As members, obviously you can have access to this. Everybody's got access to it, edgestatpro.com it's on. So you can go and have a play around with it. And I will go through what each section is and does, and potentially how we can use it, and what I want to do with it, basically, in more detail. So I kind of gave a brief overview of it all this morning, but not really going into what the statistics are, why they're there, and why they're important, and how basically to use it to trade. So I think I'll need to put together a video based on this, I think. But I've found quite a few issues with the strategies that have been traded on this, which I'll go through as well. Although it is making money, I think the execution of these strategies has got a lot of potential. So I've been talking to Nix this morning after the stream about how the strategies have been put together and what they are, because I hadn't even looked at them really, and how they're being executed. And one of the main things that was missing from this was he wasn't using risk reward parameters really to take these trades. So everything that has been traded has either been left to hit target or has been a one-to-one risk-reward ratio based on a high statistical probability of actually being achieved. Whereas you could actually make a lot more money by changing the risk-reward ratio to do with the statistics and make immense amounts more return. He's missed that point completely. So I've had a chat with him about it this morning. Yeah, he's come back and said, yeah, I've really screwed this up, haven't I, basically? You're 100% right, and I apologize. I was thinking like a statistician, not a trader. Your example, because I gave him an example of a strategy, is brilliant. And I'm going to go off and do some research. So he spun up a couple of agents to go and do this. So I wanted to cover this afternoon and look at why I've been using AI to build it, and how I think it can be used. Interestingly, I don't know if any of you guys, if you're watching on replay, obviously there's not many in here at the moment, but follow Tom Hurgard. He seems to be doing something very, very similar at the moment. I'll just show you a quick screenshot of what Tom posted today. Yeah. So he posted this today, which is like a key metrics thing. And I just want you to pay attention to the styling of these boxes. Yeah. And that label there, okay? And then look at my Dow Globex, initial balance boxes. Was it this? No, sorry, the levels boxes, right? So look at that, and then look at his screenshot, okay? Look at that accent on the side of these boxes, and look at this on the side of my boxes. And look at the way that the text and the numbers are within this box and how it's a grey box. Yeah. Look at the title there, and then look at the titles that have been built by my nicks with these little icons and the text labels. Yeah. Little icon, text label. This is exactly the same thing. So Tom, it looks to me like, is going down exactly the same route with using AI for statistical analysis, which is interesting, isn't it? We're both going, and I only saw that today. It's the first time he's posted something like this, which is very interesting. I'm not the only person with the idea of using AI to do statistical analysis, come up with edges and trade the hell out of it for us. What's the point in us being here? So yeah, I just wanted to point that out because what I'm doing here seems, for the people that have already commented from this morning's stream, have said this looks groundbreaking. And I'm thinking, I don't think this is groundbreaking. This is just what I would love to do if I had 1 million hours available to me and all the intelligence in the world. And I'm not the only person thinking along these lines, it seems. So, because all trading is, as I said this morning, is statistical analysis and probabilities, and wrapping risk and reward around those probabilities. So if you know statistical probabilities, when something happens, you know how to apply risk to reward to it. And that's kind of what we're going to look at this afternoon. So, yeah, I just wanted to point that out because I looked at that screenshot and I was like, I recognize that screenshot. It's exactly the same layout as I've got. And bear in mind, I didn't design this. The AI designed this. So if you're using the same AI, it's going to be using the same design elements, isn't it? So obviously he's doing the same sort of thing. So not that it's a race or anything. Everybody in the world can do this now because all you need to do is have an AI built in OpenClaw and do your own. Nobody's got copyright over anything on the internet with statistics. All I've done is fed it data and it's fed me back stats. So anyway, interesting. So just a quick overview. So the website is edgestatpro.com. That's where I've put it for the moment, just because I had that domain name because some people I was working with a while ago were going to run a website on this domain. They decided to pull the plug on it. So I grabbed the domain name from them because I thought it was quite a cool domain name. And I had it sitting there. So basically, I needed a proper URL to send it through. And then I got my AI to create that logo. So what it is basically is real-time statistics. So what this website is, in essence, is it gets a data feed from Robo4X, which is an MT4 terminal feeding data to here. And it stores every 5-minute candle. And I've also exported the last 5 years worth of 5-minute candles to my AI who's created a database. So I've chosen the 4 main indices. I can add whatever I want in here. I've just got to get the data together. And obviously we can add unlimited symbols. But the reason I've used these is because they have specific time-based movement. Whereas FX is 24/7 pretty much. There's no real session kickoff and end, whereas with stock indices, we know there is a kickoff and an end. 9:30 a.m. US, it opens and it goes mad. 8 o'clock UK opens and it goes mad. We know when it opens, we know when it shuts. And it has...
Lee, I think you put on music.
Sorry?
Did you put on music?
No, there's no music on.
There is. Your opening theme. Pretty loud. Or maybe I have it somewhere, but...
It must be you. I haven't got it.
It was your stream this morning.
Oh, was it? Oh, right, okay. Yeah, no, it's not me.
Okay.
Yeah, it's not my end. I'm rendering a video at the moment. This is why I thought it might be me, because I'm rendering a video, which actually is finished, so I can shut it down. Okay, so so basically, I've picked the indices because they have specific characteristics which we know will be hit regularly. We can do this with Forex as well, because Forex has high-low of the previous day, high lows of week. So we can put together statistics for levels. But the reason these work so well is because they have characteristics and timing that we can use. Okay. So we know they go explosive at set times. So the main characteristics that I wanted the AI to analyze were what happens on specific days of week, specific opens. So for example, with the DAX, if we close at 4:30 on the DAX at that price, and then the market opens at 8 a.m. there, we have a gap between the official market close and the official market open. This is where FX doesn't quite work, because FX is 24/7 sort of thing. Yeah. So if we gap up by a certain distance, we have a definite probability of that gap being closed, and they do close very regularly. So we have an advantage in that we have a direction that price is likely to head. Yeah. We can also look at where we have opened in relation to yesterday's session. So that's what the open position is. So where we have the session yesterday, high and low, if we open within that session, so let's say that's the low, that's the high, that is the close of yesterday. Yeah. This is the open of today. And if we open above the close, we have a gap up. If we open inside the high and inside the low, we open inside. If we were to open here, we would open up. Yeah, and that's what these inputs mean. So if we go open above, that means we opened above yesterday's session high. We can also filter the size of the gap. So not all gaps are equal. If the market gaps 300 points and on average it only gaps 50 points, the characteristics of what are going to happen today are going to be different. So if we gap 300 points, 10 times the average, for example, the likelihood of hitting that gap fill is going to be tiny, because it just won't be able to move that far in a day. So by using a filter like this, we can analyze out of 1,569 sessions, there were 85 sessions in the last 5 years on a Friday that gapped up inside with a gap somewhere between 30 to 130 points. So we give it a little bit of a leeway with the points. You could move that down, but you're going to get less sessions. So somewhere between 0 to 50, you probably want to put 30 in, I guess. 25 sessions. So we've got 25 sessions to look at there. So it gives you the basic statistics here of what's happening, where the current price is, the previous high, have we touched it, have we touched the previous low, the ranges, all that sort of stuff. And then we've got these trade setups. Now I'll go through all this stuff in a little bit, because this is the statistics on the trade setups, which I don't think really are quite right. But up the top here, we've got exactly what today's information is. And if the market hasn't opened, it shows you what is likely to happen at the open. And this is updated every 5 minutes. So you can see the gray candles here means we're in Globex. The market's not open yet. It will turn into colored candles when the market opens. So you can see the session. So that's where we opened. That's where we closed. This is where we're opening today. That's where we closed yesterday. So we are 58 points lower, gapped down, and we are below the session low, which is there today at the open. Yeah. So it's a specific set of instances which have happened 53 times in the last 5 years. So we can look at that and we can say, actually, just show me all of the gap downs below, regardless of what the day of the week was. And now we've got a data set of 262. So we've got more data to work with. So it can be configured and you can lock that in as well. But that's basically what the basics of the site do. We then have the tabs here, which give us all of this vital statistics. So the idea behind the gap analysis is we always have a gap on indices. When there is a close at the market, we then have a little bit of aftermarket movement. Then we have pre-market movement, and then the market reopens again. So in the case of the S&P 500, we're closing there at 4:30 US. We're opening there at 9:30 a.m. US. So all of this is pre-market data. When we open, everybody that was trading institutional closed out there is going to be either in massive profit or not in massive profit, i.e. in drawdown. If they are in drawdown, they will want to drive price to their previous position to finish what's called unfinished business, which is to get flat, basically. And this is why gaps fill on a regular basis, if they're not too big. So we have a definite advantage that we know 40% of the time that gap is going to get filled when it is a gap down below on a Friday of that sort of size. Okay, so we have an immediate statistical advantage. And you can play this in a multitude of ways. You could say, I'm going to get in immediately when the market opens or just before the market opens. I'm going to measure how far it is to that gap, which today is 58 points. And I'm going to place a stop loss of 20 points or 30 points or 40 points or whatever you want to place, knowing that if that happens with a 40% probability, you will have a positive risk reward ratio, regardless of where you put your stop loss. So it means that you can jump straight in at market open and go, there's a 40% chance we're going to drop down and fill that gap today. So I'll place a stop loss, a percentage of the gap size. So if that is bigger, you can place a bigger stop. Yeah. So you're just using what the likelihood is and the distance that is likely to travel is, and then you're setting a stop loss which is lower than that distance. And as long as it happens more than 50% of the time, 40% of the time, whatever the statistics need to be, you're going to make money. Yeah, it's going to fail a lot. Yeah, 60% of the time, it doesn't hit that gap. What it might do today is it might go up, hit your stop loss, and then do the gap fill. But you could get in another time, couldn't you? Because you'll even have a bigger risk reward then. So you could take another trade. So you could take 2 or 3 attempts at the gap fill. Entirely up to you how you use the data. But we know what the data is. And that's the key. So if you change the statistics, you'll obviously see that change the inputs rather, the statistics will change. It also gives you the gap fill timings here. So what we're looking at here is, just refresh that for the S&P. We've got these 53 sessions. Yeah. The gap fill timing here, we've got 53 sessions. 9 of those 53 sessions filled the gap within, see, I've written over it, 60 to 120 minutes. So we know that the probability, if that 40% gap fill is going to happen today, the likelihood is it's going to happen within 1 to 2 hours. So that means if the market opens, the gap is there, and the market pushes away for 30 minutes, we still know that the probability is in the next hour and a half, that is when the gap fill is going to happen. So we shouldn't be worried about the market pushing away from our gap. In fact, we should be happy because the chances are we're going to get a higher risk reward because it's moving away and the probabilities are not going to change. Yeah. So this is an important aspect, the gap fill timing. If there is a specific, in this case, there is period where these normally get filled on a Friday with a gap down below. Yeah, that's where your target should be. If you haven't achieved that within that time, it doesn't mean it's not going to happen. It could happen a little bit later. But you know that if we get to here and we're sitting around about break even, probably shut the trade out because the probabilities is not there anymore. Yeah. So it's all information that is important to do with gap fills. Gap size distribution is also important. So the gap today is 63.8. The gap we are going to have is sitting in here. Okay. So you can see here with the size of gap that we've got today, if you hover over that, the fill rate is only 25% when the gaps are these size. Yeah. So today's actual probabilities are going to be lower because the gap size is a lot bigger than normal. Yeah. This is where the standard distribution is for the gap sizes. Yeah. That is where most gaps tend to be, or there, or there. Ours sits here today, which means that it's harder to get that gap filled. So you've got all the data you need there to really make educated decisions on whether or not it's likely to happen. But this is all taken into account and given you here anyway. So if you get a 40% fill rate on these gaps, you can very easily go over here and go, okay, my probability is I'm going to get a 40% strike rate on this type of trade. What risk reward ratio do I need to make it worth taking a trade? Yeah. So you can go, okay, well, I've got a trade there, which is a 2.25R right now at the open. If I place my target at the gap fill and I place my stop loss at half of the gap size, that gives me, let's say, for example, a 1-to-2 risk reward ratio. Is it worth taking? Yes. So you take that trade. There's no reason not to take that trade. Yeah. Because that probability is statistically, historically there. It will change maybe up and down a few percent, but these fill 40% of the time. So you know you're going to be right 40% of the time. If you take every single trade, you will get 40% of those trades right. You have to have a risk-reward ratio, however, that is going to come out with a positive result. Okay, so if the probabilities are it's going to move 63 pips with a 40% probability, your stop loss cannot be 63 pips away, because that will give you a 1-to-1 risk-reward ratio, which, as we know, you need a 50% strike rate for. We're not getting that. Yeah. On the DAX, however, today, the probability of the gap fill was 69%. Yeah. With the 30-point gap that we had. So if you look at the DAX today on a 5-minute chart, I've got the wrong one up. Let's look at that one. So there's your gap today. Yeah. So we opened up here. Yeah. And that was the previous close. It was 30 points. And as you can see, it went and did it immediately within the first candle. The second and third candles also filled that gap. So when you look at what actually happens on average today with a 30-point gap, when we are gap up inside on a Friday, we hit that gap 69% of the time within 0 to 15 minutes. What did we do today? Opened, hit the gap within 5. Yeah. So the statistics are correct. Yeah. The only way you're not going to hit that gap is if the market suddenly opens bull and you get some crazy bull run start. But 70% of the time, that trade is there. So you can just take a trade immediately at the open with a 30-point target and a 15-point stop. 2-to-1 risk reward ratio, it either works or it doesn't. But 70% of the time within 15 minutes, if you haven't hit it, you get out. Yeah. So this is what these statistics are all about. There are always a multitude of ways to trade these statistics, but your job will always be to wrap risk around it. So what you have to do, cancel that. What you have to do whenever you see these probabilities playing out, like with that DAX one today, for example, you would have to go at the open, wherever we are. Oh, this is on the US. But anyway, you would have to basically say, right, let's say, for example, this Globex low is where we're headed. You can have a stop loss anywhere here, and you're going to get a 1-to-1 risk reward ratio. So if the statistical probabilities of hitting Globex low are 70%, it doesn't matter where you put that stop. As long as you hit them 70% of the time with a 1-to-1 risk reward ratio, you're going to make money, aren't you? Yeah. We get a 70% strike rate because the probabilities are whatever they are with a 1-to-1 risk reward ratio. You're generating profit. Yeah. So this is how you use this data and how you use the site to identify there's a very good chance of that happening today. How can I get in? And you can either get in straight away, you can wait for them to open. The danger of waiting for the open is obviously it flies straight to whatever the statistic is, and you don't get an opportunity to take the trade. You can wait for 5 minutes, 10 minutes, 15 minutes. And if it moves away from the probability, you get a bigger risk reward ratio. So you get more room to play with to get into that trade, which means you can have a wider stop loss on it, which means your probabilities, if that happens, of getting the trade on is going to work out more. So that's the gaps, and that's literally all you've got with the gaps. And on every single page, you've got the previous charts. So these 85 sessions, yeah, we can flick through them all. So it finds all 85 sessions where this statistic has happened, so 69%. And basically it plays them out for you. So there's your open down there. And there is your previous session close, the gray line there. So you can see we basically opened and 20 minutes, we hit that previous session. Yeah. So tick, we hit it. The next one there, I might get these cleaned up, these, because they're a bit messy. But there's your previous session. We opened there and we immediately hit that session. Yeah. So with the DAX specifically, the gaps tend to be a lot smaller because we haven't got a Globex session in the DAX. So it makes sense to go for these very quickly. They mostly fill within 25 minutes, but most of the time, as you can see here, it's in 0 to 15 minutes. So it's kind of get in and get out fast sort of thing. So that will be our prep work before opening. Yeah. So this is what this is for. So the S&P 500 is about to open. We are 64 points down. Let's look at the NASDAQ. We're 256 points down. So today we have already done 62% of the average session range. The average session range is 364. So we are down at the point now where it's 50-50 whether we'll even get to that average daily range. But we are 269 down. Look at the gap. There's a 41% probability that we hit that within 60 minutes. Okay. Our gap size today is 256, which is all the way up here. So we are an outlier. So this is where most of the gaps lie. We're opening here. So our gap is really big today. And as you can see, there's more red than green, meaning that those gaps don't actually get filled that often. So when we gap down below on a Friday, we get a 41% chance of going to that level. So if we look at the NASDAQ now, we have got the previous close here. Yeah. So at the open, you could say there's a 41% chance. 41% chance. The average gap is 145. Bear in mind, we are double that pretty much. Yeah. So there is a 41% chance of that getting done today. So if we look at a buy right now and a risk reward there, we could in fact put a stop loss all the way kind of down there. That gives us a 2-to-1 risk reward ratio with a 41% strike rate. Yeah. Gives us a positive return. It's not amazing, but it's a positive return. Yeah. So you could literally hit the button right now and take that trade. What would be better to do is to see how price unfolds. If this first candle pushes up and then pushes down and then gets down to here, and then we see a whacking great bull bar go in, the logical thing to do would be, okay, we'll move our entry down to wherever that was, and then we'll use the low of that movement. Yeah, so it's rejecting now. So let's say it does that. Yeah, we get in there, stop under there. Look at the risk reward ratio now. We're 1.425. So that is a nice big risk reward. Now, there's only a 40% probability of it happening. And we know that that will always happen typically within 30 to 60 minutes, 60 to 120 minutes, maybe 180 minutes. Yeah. So we're looking at somewhere in mid-session in the first 30 to 3 hours. That is when that gap fill is going to be achieved. So I would say, okay, let's see if that happens. If that happens, I'll get in. If within 2 hours we're doing this, I will close the trade out because it's not getting there within 3 hours. So dump it. So it gives you all this extra information, which you know statistically you can use to your advantage. How you read it, obviously, is entirely up to you. There's many, many ways you can trade this. So again, looking at the ORB statistics, we haven't got any ORB statistics yet because the first 5-minute candle hasn't gone in. Afternoon was checked. Sorry. So we haven't got any ORB statistics at the moment, but with this particular scenario where we have a gap down below on a Friday of somewhere up to 370 points, we give ourselves a little bit of a buffer around that. You can move that down, let's say 280. We could go somewhere between 180 to 280, give us a bit of a buffer. There's only 15 results there. We know that there is a statistical advantage on there's none on the 5-minute ORB. The 15-minute ORB is the one to take today. And there is a 69% probability on days like this that we will get a 1R target with a long trade off the 15-minute ORB, because we've gapped down. We are below yesterday's close, which means we're below yesterday's open, which means that the market will want to go and test yesterday's low and ideally test yesterday's close. So the market bias will likely be bullish for the day. Therefore, the ORB longs work more often. The ORB shorts are not as effective. So we know that what we should be doing today is looking for the first 15 minutes to go in and then taking a break long of that. Yeah. And being aware that the previous close is likely going to be the target today. So we can use all of this information to our advantage to eliminate shorts today on the ORB. On the 5-minute ORB, it's a complete mixed bag. And bear in mind, we've only got 16 sessions to work on here. Just open up to a bigger. In fact, we want to use we are a very big gap today. This is a really big gap. So we've got to bear in mind, we're probably not going to get them filled as much as normal. But you can see there's no advantage in the 5-minute ORBs today. We haven't got the candle in yet to give us the proper results, but there you go. It's just updated there. Win rate. Just see. Yeah, we haven't got the candle yet. This will update when the candle comes in. But there's no point in taking that today with a 100% range. So if you use the 50% range, are you still going to get an advantage? No. If you use 75% of the range for your stop loss, this is your stop loss basically, are you going to get an advantage? No. 25, going to stop out way too often. 9% of the time you're going to get a trade that works. So it's just not worth taking it today. Yeah, because statistically, these don't hit. So we don't. 15 minutes though, yeah. And if we change our stop loss size to 50%, right, we still have a 60% chance or a 50% chance of hitting a 1.5R. 75%, we're going to hit 50. 100%, we're going to hit 70. So the thing to do is use the opposite side of the range on the 15-minute ORB today and go long. Statistically, that's the best thing we can do. Now, the data set is quite small. We've only got 12. So it's not a very big data set. So we can always do something like this, remove the filter and lock it for the days and say, right, let's forget it's Friday. What does gap down below with a large gap normally do if it's not a Friday? So let's look at the whole data set. That gives us 57 instances in the past to look at, which is a nice bigger data set. You can see there the M5 data has just come in. Yeah, so we've got a 99-point open on the first 5 minutes. So your M5, let me just change that. Your M5 range distribution, okay, so this is what on average your opening range normally is usually somewhere between 8 to 22 points, up to 35 points and up to 49 points makes up the vast majority of the opening ranges. So today, not only are we a massive gap down, way above normal, we are also a much bigger opening range, much more volatile than normal. So you can, again, use all this information to say, right, this isn't a normal day. We are gapping down way bigger than normal and the open is very explosive. We want to be a little bit cautious. Yeah. So again, the long is the play today. Still. So that data has now come in so we can see what the initial range is. It just gives us that information. But, if we look at that 5 minutes now, if you go long, there's only been 2 trades with this size. Okay, so what's happened now is this statistic here has changed. Reason being is because we are now knowing what that size is. It uses size of today's gap and looks for instances where we've had a massive gap down day and we've had an explosive open. And what happened next? So if we have a range of 79 to 119 points, we will typically break up 1R and hit that 100% of the time. We will break up to 1.5R 50% of the time. Yeah. So if we go now long with a 1R using the other side of the 5 minute range, there is a pretty much 100% chance of that being hit. But bear in mind, we are looking at 2 days out of 1,500. So your data set is tiny. One of these failing will change that statistic to 75%. Yeah. So we've got to be very careful with the size of data that you're looking at. But historically, a break long now, if you were to go with that ORB long, your stop loss at the ORB low, and your target at exactly 1R is there. Every single time that has happened in the past, it's hit. Whether or not it happens today, we'll have to wait and see. It may not break up today. But we do know there is a strong probability of the previous close getting tested. Let's look at the Globex high on days like this as well. So with the Globex session, for example, the Globex high is only touched 19.3% of the time. The Globex low, however, is hit 86% of the time. So I would say the best thing to do today is to try and hunt the Globex low. Where is the Globex low? It's there. Yeah. There is no trade, is there? We opened there, and that is the Globex low. So it's pretty much opened on the Globex low. So there's no trade. You can't get a risk reward out of it. So you can ignore that statistic today because it's unusable. There's a 42% chance that we will close below the Globex low today. Okay, so you could immediately hit the short button now and know that 42% of the time you will actually close below that low. Yeah, so that could give you an idea to go short. But that conflicts what we've seen here about that gap getting filled, doesn't it? So there's so many different ways you can use this data. The 15-minute, we haven't got data in yet, but when that comes in, that will then filter these 15 sessions down further so that we've got actual statistics on the size of the 15-minute opening range. But at the moment, that long is the best opportunity that we've kind of got at the moment. So, we'll see where we go. One of the reasons we've got such a big gap today and big move is because we've just had the US news hit with the PPI figures. So obviously we've had that massive bullish move on PPI, which has driven the dollar up today. And obviously dollar goes up, stock markets come down. So that's the reason we've got such a big gap down. But PPI, and this is the reason these statistics I think are going to be so useful. PPI always happens on a Friday. Yeah. So when we do get a gap down of this size, it means there's been strong PPI numbers on a Friday. Yeah. Which means that the market has gapped because of a strong dollar. So if the market has gapped because of a strong dollar on news, what tends to happen the day when the session opens? We always get PPI on a Friday. Yeah. So 1 out of 4, 25% of those Fridays have got PPI numbers in. You've also got non-farm payroll that comes out with these and all sorts of other news events that are day specific, which will drive the market because of the news. So we can look at the statistics on news days and use that to our advantage because the market has a cycle that it goes through on a day-by-day basis, doesn't it? So that's your play today. There we go. We are long. Now, bear in mind the ORB is not using 100% of the range as a stop loss. I'm just going to execute that as another trade, basically. We'll see how that one plays out, but we'll wait for that 15 minutes to come in. So that's the ORBs. That's how they work. Volatility is to do with ATR or ADR or ASR, which is average session range. So on the NASDAQ today, we have already done 40% of the average session. Yeah. So it means that the pre-market movement has already driven price by 40%. Yeah. So we need to be aware, obviously, the average range in a session is 250. We've done 100 of that already. So if you get something where the open, and this is, remember, with the opening range breakout EA, we have the filters in there for 15 to 40% volatility. So we have 15% as the minimum that we will look at and 40% of the maximum we look at of ADR. So if we have a 5-minute candle, which is lower than 15% of the average daily range, we don't trade it because typically you will get stopped out on both sides. If it's above 40% of the average daily range, typically you won't get a 2-to-1 risk reward ratio, which means there's no point in taking the trade. So this data here is along those sorts of lines. Be aware, we've already done 40% of the average session range. So you've only got 60% chance of getting up to there before that starts dropping off. So if your target on your trade takes you beyond the average session range, 250 points, you're not likely to get there because the probabilities of actually achieving that distance is very low. Yeah. So it shows you, and it updates bar by bar that line as you get closer and closer and closer. When you get closer to this line, what should you be looking for? Mean reversion opportunities, because the likelihood of it progressing further is low. Therefore, the likelihood of it reverting is high. Okay. So this tells us when we get to these levels, we should start looking for mean reversions. Yeah. So again, ADR, it's average session range rather than average daily range. And this is your session range distribution. The vast majority of the time on these days, we tend to do that type of session range, 217 to 268, 250. Yeah. We very rarely do tiny little ranges where we are. So it tells us that the market is going to continue to move today. But we very rarely ever go above there. Yeah. I mean, and then you drop off to nothing. Yeah. So we never, ever get to 250% of the average session range on days like this, because the market's already gapped so far. It always wants to use a magnet to try and go back the other way. So that volatility is kind of like ADR, and you can adjust it as well to go back. You won't find a lot of variation in it. That's more sensitive, that's less sensitive, but you'll see the numbers are similar-ish, or the distribution of them is anyway. First candle data is very interesting. I know this is something that Tom Hurgard has looked at in the past. He's got, I don't actually know what the strategy is, but I know he's got a strategy where if the first bar is bullish, you go short or long or something. I don't know. I don't know what the strategy is, but this is an interesting statistic that Nick's came up with on what happens when the first candle hits. Okay. So these lower time frames, I don't think are as reliable. I think the higher time frames are the ones you want to be focusing on. We're waiting for the M15 candle to close. We haven't got that data yet, but we have got the 5-minute data. Yeah. So I'll show you what it means on here until we get the 15 in, which should land any second. The first M5 candle, 50% of the time is bullish, 50% of the time is bearish. We know the market's binary. Half the time it will be bull, half the time it will be bear. That's pretty standard stuff. On average, the typical open on 5 minutes is 27 points. Today, we opened with 99 points. So this is telling us that today's open is 3 times larger than normal. Okay. So what happens when that happens? And we've only had that happening 6 times in history. What has happened on those days? So the next candle, 83% of the time, reverses. So when we get a bull candle on 5 minutes, 83% of the time, the 10-minute candle will be bearish. Yeah. This instance, it didn't actually go anywhere, did it? So the 15-minute candle there is bearish in this particular case, but we don't measure that one, so we can't use that. So that's next candle. This is why I think this is a little bit, the 5-minute time frame, I think, is a little bit too low for this type of data to be actually relevant. But what this is telling you is what's the probabilities of when this happens, the next candle or candles or within a certain period of time us being at a certain location. So after 30 minutes, 67% of the time on days like this, we end up bullish, i.e. we close above that first 5-minute candle. So if we pull back after 5 minutes, you could take a long trade knowing that 67% of the time within the next 20 minutes, you'll be back up there again. Yeah, that's how you use that statistic. How far? By 54 points. So if you set your target 54 points higher than the 5-minute open with a stop loss lower than 54 points, the probabilities are that you're going to hit that with a 67% strike rate. Okay. It pulls back 83 points though. So when we get that first 5-minute candle going in, it can pull back 83 points before it pushes 54 points above. So if you pull back 60 points, for example, you could set an entry price with a stop loss of 30 points. And actually you'll have a 50-point move plus the 30 points we've pulled back or 60 points we've pulled back or whatever it is. Add those two together and you can calculate a risk reward ratio that will give you a nice profit with a 67% probability. So this is what it's all about. It's about formulating plans around statistical probabilities and data. Yeah. So, and this is the next stage, is to get all of this analyzed so that we can come up with real strategies that are likely to work. But the trouble is this data changes every day, because what we're doing is we're analyzing what happens normally on days like this. We're looking for days like this. That I'm unsure as to whether or not is good to have the actual day, but who knows? We'll have to sort of try and figure that bit out, I guess. So the 15-minute candle is now not in, updated. Yeah, that needs to update automatically. You need to check that. So you're bullish. You've had a bullish M15 candle. There we go. So we're long. We've stopped out, double stop out today. But yeah, your first 15-minute candle is bullish, ever so slightly, only 30 points. The actual candle size, though, is all of that candle, isn't it? 126. So yeah, 125 points is the first 15-minute candle, which is bullish. So when you get a bullish candle, which is 125 points, typically, as you can see here, within the next 30 minutes, all the way to session close, the probabilities are that it will close higher today. Yeah. So we're looking for longs, basically, is what this is saying. That doesn't mean it's going to happen. There's a 42% probability that it won't happen. But we know that the vast majority of the time, after an hour, 63% of the time, we're up above that 15-minute close. Yeah. So we're looking for long trades. We also know that we've got that statistical advantage of the opening range breakout long working. We also know that we've got the previous close statistically that we're going to go for. It's all the pointers are at potential longs, aren't they? Whether it happens or not, it's all down to statistics, isn't it? But we've got the same data there for the 30 and the hourly. We can also lock that by size. So at the moment, this shows you all the data. You can filter by size, yeah, which will show you all of the sessions, which are 125-point candles within 20%. There's only been one instance in the past with this scenario. So this data is 1 out of 51, but of that size, we've only had one of them. It's just not big enough sample size. So you only really can use these filters if the sample size is big. You've got to have enough data in your set to have a statistical probability. When I'm doing back testing and robustness testing, any system or strategy that hasn't taken 100 trades a year, I throw away. Or 100 trades in the time. It depends on the time frame. But if you haven't got a data set of 100, really, 30 on daily time frames is good enough. But on any time frame less than that, you need at least 100 trades so that it's not curve fit. You've got to have a big enough sample size. And I think this is the only area this data is going to have problems, is some of these data sets come out too small, which means that you have to kind of try and get rid of some of these filters to give yourself a big enough data set. So if I say, forget Fridays for the minute, let's just look at all days where we've had a massive gap down below and the first 15 minutes has opened bullish with a massive candle. Can we filter that? There's only 5 of those and 60% of the time it always goes long. But if we take the size filter off, we see that the bias is always still long. So it's just saying we should be looking for longs. Yeah, that is where that information came in. This is where we are now. Yeah, statistically, it's doing what it's always done in the past, which is when you get a bullish 15-minute candle on a massive gap down day with a gap to be filled yet, we tend to kind of go towards it. It's the magnet. There's unfinished business at this price point. Market wants to get back to it. Yeah. So, all of this data is useful, but it's a little bit of a data overload at the moment, because in the past, we've never had this much information really to look at. There's this, this type of statistical analysis would typically take months and weeks of brainstorming, data analysis, all that sort of stuff, which obviously has been knocked up in a week. So it all works. It even gives you EV point expectancies. If you were to take every one of these trades, where you would end up. You know, it's just unbelievable what he's done with it. I say him. I don't know whether he's he, she, or what he is. But anyway, levels is the next section. Level touches, very, very simple. On days like this, how often do we touch the previous high? How often do we touch the previous low? How often do we touch the Globex high and the Globex low? So with these, I would be looking for anything that is a decent probability. That one, touching the previous low, we've already done it. Yeah. So there's your previous low. We hit that on the first 5-minute bar. Not really enough room to take a trade, so no good to us. The Globex low, we opened at the Globex low. Not really any use to us, yeah? So we touched the Globex low on that 15-minute candle. We pretty much opened at the Globex low. So again, no use to us. So some days these will be no use. The days these will be useful is where we are opening inside. So when you open below, you're really only ever going to touch this one. You're very rarely going to get to that one because you'd need an outside bar to be painted. They only happen 9% of the time. So it's very unlikely that you'd get that. But this, if you've on the Globex gone way below the previous low from yesterday's session, that's a really good target. Globex highs and lows. If the market has during Globex done this, and this is where we open, these will be statistical probabilities for targets up and down. Yeah. So again, we can aim for these as targets with a high probability. And if we've got 90 points there, we can use a 45-point stop loss to guarantee a 2-to-1 risk reward ratio with a strike rate which is high. You just keep doing the same thing over and over again, and these strike rates will eventually play out into a positive edge for you. Obviously, each day is going to be different. Also, timings. So one of the things that people get stuck with, me included, a long time I got stuck with this, is how long do you hold a trade for? RSI is a very similar thing. When you get in on an RSI extension, one of two things happens, or an ADR extension. It either comes down or it goes sideways. The probabilities of it going beyond are low, but it will either do that or that. When it does that, it can do that and stop you out. So if it does that for anything longer than mid-session, close it because the probabilities are then 50-50. If the trade has played out within that time period, we're done. Yeah. So it gives you an idea of how long it will take. So if we are going for a previous low touch because we've opened below and we've got 90 points to the upside to play with, if we get to the last hour of trading and we haven't got to that target, shut the trade because there is only a 25% probability you'll make that, which means there's 75% probability it could come back down to your open. Take the money, take what you got. Yeah. And the same with the previous lows as well. We need to get the Globex in there, although that might be on there. Oh, yeah, there's Globex. Okay. So kind of need to get these levels taken out, don't we? Really, the Globex out of here. Globex, very, very similar. What are the probabilities of hitting those levels? 69 on the previous, so Globex high is 41.4. Yeah, 41.4 and 72.7 on the Globex low. There we go. Yeah, so those stats are the same. We also get additional information here on this session. This is obviously only relevant to US. On the DAX, you don't get the Globex because there isn't a Globex session. But on here, we've got the Globex information as to how often on days like this, we close above the Globex high or below the Globex low. Okay. So when you've got a statistic like we have today, 19.6% above the high and 25% below the low, it means that there is a much higher probability today that we will close within the Globex range. So you can take from this information here, there is a 45% probability of closing outside, which means there's more probability, 55%, that we will close within the Globex range today. So today, I would say there's more probability of closing within the Globex range or below it. Yeah. So as we get towards the last hour or two of the day, you can go and have a look at where the Globex low is and say, there's a good chance we'll close below there or somewhere around here. But the chances of closing above that high are very remote. So if we see price up here with the 2 hours to go, you've got a very nice short opportunity because you can put the stop above the Globex high and know that the probabilities of your stop being taken out today are only 19%, which means that by the end of the session, you have an 81% chance of still being in that trade, which means that there's a good likelihood you'll be in profit. So you may not hit that stop, you might do, but if you don't hit that stop, you could have an unlimited amount of profit, couldn't you? You could have a tiny bit of profit, you could have a tiny bit of drawdown, you could have a large bit of profit. You know the chances of your stop getting hit are very remote. Okay, so again, these are the ways you need to think outside the box with this information and formulate strategies. So right now, where are we? Where are we in relation to everything? How can I formulate a trade with a risk-reward ratio that's positive based on what's likely to happen for the rest of this day? When you're going to hit them as well is also there. And your last one is the initial balance. Now, initial balance is officially in futures the first hour's range. This is up for debate because some people class the initial balance, as I have in the past, as the 30 minutes, your first 30-minute candle. Because when you're looking at TPO charts are charted in 30-minute intervals. So a lot of people class the first 30-minute candle as the initial balance or the first TPO candle. The official definition is it's your first hour's range. So what this is doing, and I'm not sure whether this is actually going to be any use, is it's saying what are the breakout statistics for the initial balance. On days like this, 66% of the time, we break out above the first hour. So it's like a 1 hour ORB, if you like. It doesn't say how often we close above or below the initial balance. So that data I think I need added in here, which would be useful. The initial balance, obviously, we haven't got the data for it yet, but on average, it's somewhere between 120 to 155 in size. This is the interesting statistic, the break both. Now, if you have a high percentage here, which we haven't got at the moment, but if that percentage is like up in the 65+% range, what that tells me is that there is a very high probability of breaking the high and the low of the first 1 hour's trading. So if we have got that 1 hour trading in and the second hour closes bullish and there is a 65% probability of closing both sides out, I've got a very high risk reward trade there with a very high probability, which I can place any size of stop loss I want on to create a positive R, knowing that there's a 65% probability we'll at least touch it. We don't have to break below it. We don't have to close below it, but we touch it. We break both sides of it, and then it can close up there if it wants to 3 hours later. But I know there's a high probability of hitting that level. So that's where I think the advantage is with this. If there is that, then I would say that is the best trade to take. Wait for the first hour. Wait for the second hour to choose a direction and then counter trade that direction. Yeah. We need to look at average ranges and that sort of stuff as well. But I'm not quite sure how these are going to be useful yet, but they are well-used statistics. I didn't come up with these. He decided to come up with initial balance. He thought it was important. Bear in mind, he's done all the research, not me. So, but probably because other people talk about IBs. The same statistics are true of this. Okay, so I just refreshed that on the NASDAQ today for the ORB. We've got no data because this candle is so big. Let's have a look and see if the very little data. Look at that 547-point gap on the Dow. Target hit on the Dow. Yeah, I mean, look at that previous close there. I mean, the probabilities of hitting that are going to be virtually none. 39% of the time. But if we move that up, so 547, let's say a 450-point gap is huge on the Dow, isn't it? They never fill. Yeah, that's not going to fill, is it? Yeah, even if it was a 350 point gap, massive. There's very little chance. So we know that we're not going to fill that gap. That's not going to happen. There's no way we're getting there. The Globex high, we can look at how we think we're going to go Globex high. Yeah, 21%. That seems pretty high to me. Obviously, the Globex high is lower than the previous close, so there is more probability, but very rare. Touching the Globex low 78% of the time. We went straight through the Globex low at the open, so that's irrelevant. The initial balance, 21%, nothing much we can use there. First candle, so there's an edge here that it's come up with. Look, every now and if it finds an edge, it comes up with it. After bearish M5 candles, 86% of them reverse within 30 minutes with a 168-point average. Consider long entries after a bearish M5 close with a 30-minute target. See, we didn't get a bearish M5 close. We got a bullish M5 close. So that wouldn't have been a play. The 15-minute bearish, after a bullish 15-minute candle, 80% reverse. We got a bearish today. So again, these edges it will give are high statistical probability, but it doesn't mean that the candle's done it today. Fortunately, yeah, there's a lovely edge if it had closed that way, but it didn't. It closed the other way. So it's not used to us. Again, I think a lot of this needs fine-tuning. Why bother telling us this if it hasn't happened and we can't use that information? It does give you on the summary key insights. 57% of sessions are bullish, close higher than the open. Gap and go, only 21% of gaps fill. Gaps tend to extend on the Dow. Trade in the gap direction. Correct. Today. Globex low is a key level, 78% touch. We blew straight through it at the open, and it normally hits within the first 30 minutes. The initial balance extension is on average 182 points when it breaks up. So after the initial balance is in, which is the first hour of trading, which is your first 12 bars. So by the time we get to that level there, that candle, it's saying there's a long bias. It will break up by roughly 182 points. Let's see if that happens. First hour predictor, 71.4% continue in the same direction. Yeah, so whatever the first hour is today, 71% of sessions close in that direction. So looking at first candle on the hourly time frame, we're waiting for that to close, but there is a high probability of that continuing in that direction, and we actually close the session out at that level. So again, all these statistics are, I really need more time with this to verify this data, but there's some absolutely gold nuggets in here with some of these stats. So there's none today because today is such a volatile day. It's very difficult. I'm just going to quickly change it to all just so I can explain some of these. Okay. So looking at all opening range breakouts as an example. Now we kind of know this statistic anyway, but with opening range breakouts, if the first 15-minute opening range is between 21 to 31 points, okay, 76% of days, it will hit both sides of that range. 8% of days, it will open and fly down and never come back to the initial opening range, okay? So what that tells us is that there is a 92% probability if after that 15 minutes, the market then continues in that direction, there's a 92% probability that it will revert back because only 8% of the time does it continue and never come back. And 76% of all days, it will touch that area. So if you get a 15-minute ORB that breaks short and you hit the long button, you have a very, very high probability of that getting hit as a target. So you can use the opposite side of the opening range as a target when it continues in one direction. So if you get a scrappy open that does that on the 5-minute, these statistics aren't going to work. If you get a strong open on the 5-minute that goes something like that, that has a 76% probability of happening. So you can measure the distance there. And again, pick a stop loss of any size you want to, and give yourself some kind of positive risk reward with a 76% probability. Yeah. So there's some absolute gold mines that I'm spotting in here, which are really easy to trade. If we know that only 8% of the time after a 15-minute candle of that size, it continues south, we know there's 92% chance it's going the other way. Yeah. So you go long. And same if it breaks up, there's only a 16% of chance of continuation, means we've got an 84% chance of it reverting. Go short. Yeah. So this, although it's tiny, I think this is probably one of the most important statistics to do with opening range breakout, which I've never looked at before. So some real eye openers in there, but also that 1 hour long that it's said to do on the DAX. There we go. Stopped out on the Dow. There's that reversal going in. So on the DAX, I know what's in the NASDAQ, wasn't it? There's that long 1 hour it's on its way to, which hits with 100% probability. Or whatever it was. I can't even remember. There's so many stats. It's the trouble. You kind of get a little bit overwhelmed, don't you? Which one do you use? You've got to basically put together a set of strategies and just trade them all. I think that's the way to do it. So it needs automation and needs Nick's to go through this and really identify. And that's what he's working on for me at the moment, is the strategy document. He's actually just produced. I'll look at that in a sec. Let me just catch up on chat. Feels like a lot of analyzing. Yeah, this has to be executed by EA. Yeah, so the EAs would be good. Yeah, so I'm not quite sure what my plan is yet. I've literally just asked him this afternoon to go and try and formulate some strategies and come up with a report, which he's just done, on some edges that we can use with these statistics. I think really I need to spend some time analyzing this, because I found some gems in there already, and build an EA, or get him to build some EAs which will use these statistics. So I'll tell him what I want to look at and test, and then run those in the back test and manually. Because there are certain things which he can't quite do yet to do with trading. He's very much looking at it from a statistical probabilities point of view, not from an experienced trader who can read price action. No, he's not there yet. So I'm looking at the Dow now going, look at the size of that candle that we've just had, that has happened within just after the first 30 minutes gone in. So I'd be going and looking at statistics now on the 30-minute time frame on the Dow when we get this sort of move. Yeah, when it's a bearish bar of this size, what happens next? They only half of them continue. When they revert by around about 25%. We've just done that. So there's not really any useful information. Oh no, sorry, it's after bearish first candle. Yeah, so there's no edges here, look. There's nothing highlighted in green. If there was an edge, it would be highlighted in green, and there's no edges here. There you go, there's one there. These are non-edges, by the way. So these are edges. 57% probability after the first 5-minute close is bearish with a candle of that size. We actually close 57% of the time below that candle at the end of the session. So it's saying we should, with a 50% probability, shut with a bearish close today. Not that helpful, is it? 57% is not high enough. 5-minute candles, I'm not really convinced about. One there, but so yeah, it's just about looking at what's happening in the market and going, right, this looks like a long. Statistically, is there anything I can formulate as a plan here to take a long? So do we test the previous session or the daily low very often when the market is like this? 44% of the time we do. Yeah. So there is a probability of taking a long trade on that, on the US 30. There. Yeah. And going for the previous session. previous session low. Okay, so I can formulate a trade there which gives me a 1.83 risk reward with a probability of 44%. Not great, is it? But if this pulls back down into this propulsion gap, which is about to form, and then I see a little bull candle going in there, I can have my stop below the propulsion gap, an entry there, and that will give me somewhere in the region of probably a 1 to 3R. Tradable. Again, it's all about trying to do the maths on this and use this information to our advantage, which is the next difficult part. But yeah, I think an EA to back test this is really the next logical step. But I'll have a look at what he's come up with. So favorable risk reward settings with tight stops and wide targets is what he's been looking at, which is what I told him to go and have a look at. All these strategies use a 2-to-1 risk reward ratio by engineering tight stops and wide targets. This means we need far fewer winners to be profitable. He's just back tested 13 strategies with 51,000 trades. Winners have to have a profit factor of 1 with a minimum of 100 trades, which is what I was saying earlier. We've got to have a good data set to make it robust. And he's obviously done all those indices. So P&L shown, end of day exits are excluded. So we're not using end of day exits. We're using fixed TP and stop loss levels. Triple aligned, he's made strategy names up. I don't even know what a triple aligned strategy is. Oh, he's explained it down there. Took 183 trades. TP was hit 50% of the time. Stop loss 77%. Oh, closed end of day. Oh, right. Okay. So all these strategies either hit TP, hit stop loss, or they're closed at last candle, right? So end of day close. Average R is 2. Total R returned is 374. So bear in mind, if you're trading prop and you're betting 1,000 per trade, you've got $374,000 return. Not bad. Profit factor 0.41. Sharp ratio is good. Maximum drawdown is 13 grand. So you will have blown the account, but who cares? Run multiple accounts. Run multiple accounts with half the risk. You will get this. You'll get half the reward, but you'll keep the accounts. You'll get paid. Gap fade, tight stop, previous low touch. So these are all positive R strategies down to there, and then these are all negatives. Fading the ORBs, interestingly, which is the strategy that I asked him to have a look at, doesn't work. I'll need to look at that because I think that's a really good strategy. Anyway, triple aligned tight stop. Gap direction plus 15-minute first candle plus ORB break aligned, gap up bearish. These rules don't make sense. Human readable. These aren't. Triple aligned. Maximum confluence. Gap direction plus M15 candle plus ORB break. Right. So he's saying the first 15 minutes and you break long on the ORB in the direction of the gap. When it's a gap up with a bearish M15, I don't know what, he needs to explain this. That doesn't make any sense to me whatsoever. In kind of AI code talk, isn't it? Right, so these are statistics on how stuff closed out. Right, so basically what he's saying is with end of day close, you return a positive R. If you just use a TP and a stop loss, you will get stopped out. So don't use a stop loss or TP, kind of what I keep saying in it. Stop losses are going to get stopped out. If you use an end of day close, you will take losses at end of day, but you won't get taken out of the trades. So statistically, if something does X amount of time, you will get that all the time. But you won't get stopped out of those trades, will you? Because you don't use a stop. Per symbol breakdown, all profitable but the DAX. So it's US indices, that one. Gap fade, double confirmation, gap fade and M15 candle, both aligned. gap up and bearish M15 short. Can you make EAs, or make one EA that trades all these strategies? Make sure it works on all brokers with any amounts of decimals. So I can test them. I need to turn each on and off in the inputs. Maybe give me set files for each. Getting to build the EAs. It's quicker than asking the question. I can visually see what they're doing then. So yeah, but these are all coming out with positive R's. Mirror of previous high is a previous low. I don't know what that means. Direction is long only because it's indices. Target is the previous low. Stop half the distance below the open. Logical. Again, I don't know what any of these mean because he's not given enough information, but he's come up with a load of positive strategies. Strategy rules reference. Oh, here you go. Wait for the 15-minute ORB, the first 3 bars to break one direction, then walk M5 bars looking for reversal candle. So we wait for a reversal after the ORB, and then we close against the break direction and target the opposite break. So that's the strategy that I said about the ORB fade 15 minutes. That's the one that's not worked, isn't it? Yeah, there we go. Right. Okay. So he has listened to the strategies that I just basically picked a strategy at random and said something along these lines. Go and find me loads of those. So yeah, that's interesting. Okay. So this is a kind of a breakdown of those strategies. Okay. So the coder is working on that. 9 strategies is going to give me. Ooh. Yeah, so there you go. So that's basically the website. So go and have a play around with it. It still needs some work on it, I think, because there's, like you said, whoever said it is information overload at the moment. There are an awful lot of possible edges that are being generated on the fly. The thing that really concerns me about this is if you don't have many sessions available to you, what you're doing is you're looking at 2 instances out of 1,500 odd that have got a 100% strike rate. You can coin flip that. Yeah. So the thing I think that is the most important here is that when we're looking at this information, we have enough data sets to work on. So where you have a statistic, we need a decent amount of data. So, there's been 85 times we've had this scenario happen in the past on a Friday. That's a fairly decent data set. When you get other things like we've got sort of a big gap, for example, there's going to be a lot less of them. Therefore, the data is going to be less prevalent. So it needs some thought as to how to use it, but this can all be tested. So some really good edges, I think, in here. Great for targeting, I think. We've got some ADRs being hit. You see, stuff like this is not going to. Done it. He's built the EA. Actually, he's built multiple EAs. So he's built an EA for every strategy. Work for me, but that's fine. So yeah, stuff like this. Yeah, large wicks, large wicks, large wicks, large wicks. This is telling me to get out of this trade. This is the type of stuff that he doesn't see. He can see it because it's being painted for him. in front of his eyes. Yeah. Whatever chart I was on, I think it was on NASDAQ, wasn't I? Yeah. So, he is getting this information, wicks to the upside. So it's about training, I think. We need more training on how to sort of adjust his thinking a little bit, to think about how to use this data more effectively. I was thinking, if for a start you choose a strategy type you trade, like want to test, and it gives you just that with what to do today. Yeah, so that is basically what this is. The reason I've said when he first built this, what he did was he put everything on one page. And I said, this is way too much information. I don't know where to look. I can't find anything. Separate it out into what types of data we're looking at. So if you're interested in trading the first 15 minutes and you're looking for a strategy to trade around the first 15 minutes to an hour, you should be looking at what typically happens at the open. So although this is called the opening range breakout, ORB tab, what this is doing is it's telling you what happens at the open. Yeah. So again, this is an absolute anomaly day. You're not going to have any data really to work with here. It's just not going to help you very much today, I don't think. Because, when we're you can immediately open this up and go, holy crap, we're an outlier today. I have no idea. Yeah, that helps you in itself, doesn't it? It's like, what should I do today? I don't know. It's huge gaps. So, but you can look at it and go, right, 62% of the time it touches both sides. So you watch the open unfold, yeah, and you go, okay, we got a bearish break. There's a nice big hammer gone in there. 62% of the time, we actually break both sides of the opening range. That's how you use it. Don't look at the rest of this. Yeah, do that, right? Take a trade. It will either work out or it won't. Yeah. When you're an hour into the session, you can go and look at levels, right? So, first candles and say, right, we're an hour in. What happens usually after the first hour has gone in? So we haven't had that hour yet. But let's say we have. We'll look at the 30-minute. And we can go, okay, right, today we're bullish and it's a 155 point candle. After a bullish candle like this, on a day like this, we tend to, within 4 hours and towards the session close, more often than not, close long. So maybe what I'll do is I'll wait for some pullbacks after this first hour and see if we pull back into the first hourly candle, and I'll have a crack at some longs, because I know that usually in 4 hours time, 63% of the time, we are higher than that first hour's close. Yeah. So you just look for some scalps long, but it gives you a bias. It gives you something to do that has a probability of playing out. Whereas when you are opening a chart up, you are looking at something blind. You don't know what's going on. You just look at it and you use indicators to give you bias. This is not giving you bias via an indicator. This is giving you bias by statistical probabilities of what's happened in the past, which is much more effective than any indicator will ever be, because it knows what has happened and it knows where things have moved and how far they've moved based on what's happened today. Don't forget, this is something that has been in existence for over 100 years. It is based on businesses that are statistically going to produce revenue and increase stock prices. And this is why I've picked the indices, because they are a beast that constantly goes long because of human greed and the way that business and economics works. Therefore, it repeats itself constantly. The cycles constantly happen in the same way. The days unfold in similar ways. The open does the same thing regularly. Yeah. When you get a big explosive open, the same thing tends to happen on other big explosive days. So we can use that information to our advantage and look for what is the most likely thing to happen. If you're looking in the direction of the most likely thing, you're going to be right more than you're going to be wrong. That's all it's doing. It's giving you a bias and an idea of what to do next. Should I, after the first 30 minutes, be looking for long or short trades? Long. All of them. The next candle should be long. The next hour should be long. The next 2, 4, and then we should also close long. Should you be looking for shorts? No. There is a probability that that will happen. But if you are looking for longs today, how much should I be targeting? Well, I reckon we'll probably do around about 127 points by the end of the session. So if your target is 400 points away, you know you're not going to hit that. It gives you information that's useful, but it doesn't tell you how to trade. Yeah, that's the next step, is how do we execute? You're only going to execute in the same number of ways. Yeah, a moving average cross, a market reversal alert, yeah, a 3-bar reversal, a bullish candlestick. If you're looking for longs, you're looking for price to confirm that for you. When you get that confirmation in price, take the trade, put the stop in, and know how far price is likely to go next. That's what you can do. That's all you can do. Yeah. If it's going to go against you, how far is it going to go against you in the next 2 hours? On average, 93 points. Yeah. If you set your stop more than 93 points, I mean, you could use this as a positive, a negative R strategy if you wanted to. Yeah. You know that most of the time it won't move more than 93 points against you within 2 hours. Yeah. And there's a probability it could go 93 points in your favor. It's a 1-to-1 risk reward ratio. So if after an hour and a half you're sitting there with a 0.5 R in profit, stick it in the bank. But give yourself the chance to sit there for 2 hours. Don't put a stop loss at 40 pips because you know it's likely to get hit. Yes, it gives you that confidence to structure your trade, which is what most people struggle with. How should I do it? Yeah, that's where I think the edge is in this. That's why I called it EdgeStat Pro, because that's why the guys that bought that domain initially called it EdgeStat Pro. It gives you edge through statistics. It's what it's doing, isn't it? It's helping you. But anyway, it needs a bit of work. Euro Swiss is at 225 ADR, is it? Blimey. Certainly is. This is a safe haven run. Money, you know why this is happening today. There's massive troops massing. And Israel has a lot of fighter jets out in the open at the moment on runways, which the aerial satellites have picked up on. We know Trump is likely to go into Iran, and Israel will go with him. There's massive troop movements happening towards that area. What could possibly happen this weekend? Conflict. Where do you put your money in conflict? Safety. Where's safety? Swiss franc. Yeah. So this looks like a safe haven run. So yeah, I mean, we may be seeing the banks and institutions just putting their money away, just in case this weekend. The yen might be powering up as well. Nope. Terminal's gone. Go slow on me. Change this setting in here. Yeah, no, so no safe haven going into the yen at the moment. The Swiss franc is the mover, isn't it? Yeah. It's all going into the Swiss. US might attack Iran. Yep. Not to derail the discussion, but I'm new, so I just want to clarify: are you still position trading, and will your edge statistical analysis tools be applied to position trading as well? No. So no, I'm still position trading. Yeah, sort of. Right now, I'm still in trades on my MT5 account, and I've got an MT4 account which I'm moving back to because I can't stand MT5, which I'm waiting to get out of some positions that I'm in, Aussie US being one of them, pound New Zealand being another. Just coming down at a rate of knots today. That hasn't come down to those lows. So we're back down to this support, which is where I want to get in. So, yeah, statistical analysis is no good for position trading, because position trading is about moving in and out of market movements, and it's to do with Forex. And statistical analysis in Forex isn't as good because it's driven by fundamentals, and fundamentals change. So all statistics you see in the past of how the US dollar has acted won't act the same when Trump's in charge. They won't act the same when we've got a 5% interest rate to when we've got a 2% interest rate. So statistical patterns are a lot less effective on FX markets, because they have different personalities due to different things, and mainly driven by fundamentals. So you won't find statistics is useful. I am going to get him to look at adding some FX pairs in here, because I'm curious as to what. I mean, the gap analysis is no good. ORB is no good. Volatility analysis is probably not that useful. I mean, none of this is really any use in FX. It's all to do with scalping low time frame. You don't have these levels as much. It's all to do with intraday trading. Yeah. The market moves in order blocks, basically. So an order in a bank will be split into multiple parts and executed over multiple trades. Once that order is executed, that market movement stops. So the way that they execute orders in all markets is virtually the same. So when you see a movement happen, you know after that something else is likely to happen. You don't position trade intraday because it's too aggressive and you will get in right at the beginning of a squeeze and you get killed. So this sort of data isn't any use for that. Position trading is about mean reversion on large moves, and we identify large moves through relative strength in the market, which is why we use RSI or time. You know, if you get 8 candles in a row on a daily time frame, it's time to get in short. But the RSI will have told you that, because the 4-hour RSI will also be extended above the 80 level. Yeah. So we use RSI because it tells us what the market is doing and how the market's moving. And as long as the market moves like that, yeah, we will always make money, because we are scaling in, ready for them to take profit. When we get in, they take profit. When we get in, they take profit. Yeah. Statistically, how long these last and how far these go is random. Yeah. There is no normal, if you like. Normal is the RSI. Yeah, abnormal is when the RSI gets extended and resets without price moving, which gives you divergence. Yeah. There's nothing I can think of statistically that I could ask to be researched that would give me an advantage. Indicators, I think, are the best thing for it. I mean, you can look at I guess you could do seasonal analysis, but again, you know, seasonal analysis is only useful if the fundamentals are the same. If you look at the on the members site, already got it open. If you look at the fundamental data on here, and you look at things like interest rates, and how they change, yeah. So if we look at like the euro rate, I haven't got it. I can't see a chart of it, but let's have a look at the PPI, for example. Yeah. So if you look at the PPI results, when that is happening, the dollar will be strengthening. Yeah. When that is happening, the dollar will be weakening. Today, we've just had the dollar strengthening. Yeah. And the last time we had the dollar strengthening. Yeah. So the market has moved up on decent PPI numbers. So from a statistical perspective, we can analyze price movement, but what you need to analyze is this, how fundamentals line up to drive price. So these are the leading indicators of price. So it's very difficult to, and this is what the analysts' jobs are. In the banks and institutions, these guys that do fundamental analysis are paid 90 to 100 grand a year, 120 grand a year, some of them, to do statistical analysis on fundamental impact of market movement. It's much more complex than just these we have here. There's tons of other stuff that goes on. And also, don't forget, in banks, they can move the market because they have the funds to do it. So if they need to move the market 125% of ADR today because they need to get out of a position, they will move the market there. There's no bank that can stand in another bank's way because they've all got as much money as each other. So they will even take the other side of each other's trades to help each other out. There's nothing you can really look at, if you see what I mean. With stock indices, 9:30, there's a free-for-all on stock indices at 9:30 US and at 8 o'clock UK, on the UK stock indices and German on the DAX. We know that patterns form at those points. As the initial flurry comes in, the opening ranges are formed. Based on that information, what typically happens for the rest of the day on a small time frame, you can repeat that cycle tons of times and you will get patterns out of it. So that's why I focused here. But I'd love to use something like that in position trading. But as Nick's said in his document, position trading is not a good strategy. So, and he's right, but he's also wrong because he hasn't got the human element in there. If you just run back tests on position trading, it will get into trouble. And that's when you have to pull the plug. So there's always a way of exiting a position, which on paper, mathematically doesn't look correct. Yeah, so I don't know. It's one that I can sort of send him off to research, if you like. So he's just created 5 EAs. Oh no, he hasn't. He's created 1 EA and 4 set files. I won't keep you long. I'm just going to quickly see what the EA is like. EdgeStat Pro EA is called it. It's a novel name. Yeah. Right. Let's have a look at what this thing does. Let's see if it works. EdgeStat Pro EA. Where's it gone? End of day 16, session start 10. So this is DAX. This is set up for. And there's all the strategies. And they are, I presume, magic numbers. Okay, so just run this on the DAX and see what happens, shall we? This could do absolutely anything. That looks like it's taken an ORB to me. That looks like it's losing every trade as well. Yeah. What is that doing? Oh, he's got different set files for different. All strategies on. Okay. I'm not convinced by this. This is why I need to test all this. So all strategies on. DAX config All strategies on. All strategies on. Okay. Yeah, I don't. Let me just run this in fast mode just to watch the equity curve. I'm not sure this is either this, everything he's done is absolute rubbish, or this EA is not executing in the way that it's designed to. This is part of the problem I'm finding with what is being done by AI and what is being done in here. The backtesting engine is very different, I think, and this is where we're getting a little bit of disparity coming in. Which is kind of why I wanted to see the statistics, because I think there are ways that you can trade using those statistics that are difficult to automate. Oh, hello, we just made some money there. And I'm not convinced that a lot of this might be able to be automatable, because every day it's going to need to get those statistics. So it'd be quite a complex EA. I'd be surprised if this actually does everything that it says it should. Oh, right. Okay. End of day. Yeah. So this makes good money on end of day results. It doesn't make good money with stop losses. I don't quite know what he means by that, but anyway, that needs work, definitely, obviously, because it's a terrible equity curve. Backtest has showed that tight stops are 50 to 25% of the range. Yeah, so why are you focusing on opening range breakout? I told you not to focus on opening range breakout. I need to read, there's a whacking great messages coming. I need to read exactly what that does, but that looked a little bit ORB to me. Let's just quickly see what that's, and NASDAQ's done. There we go. So target hit. So that trade that I took with the one-to-one risk reward, done. So, you know, there's a profitable trade that came out of a statistic. I can't even remember which statistic it was. It was something to do with the NASDAQ, wasn't it? I can't even remember what it was, but whatever it was, it looked like a good thing to do, didn't it? It was that, wasn't it? Yeah, there we go. So that was the statistic I was looking at, I think. 15-minute ORB, wasn't it? Using 100% of the range. It gets to 1.5 hour. In fact, it's done 2 hours, so I've actually got out of that early. In fact, to do 2 hour, it's got to get to previous close and Globex high, isn't it? And I think that's the statistic which, oh no, there's a 43% probability. So that is on the cards. We need some time, don't we? We need to spend time looking at it. Are you moving away from position trading completely? No, I've always run both. They are very, very different strategies and they complement each other. So everything that I do intraday on low time frames is high risk, high reward. Everything I do in position trading is long-term, low reward. Yeah. So position trading is my bread and butter, 5 to 15% on average per month. Intraday, specifically with stock indices and any FX intraday, is high reward, but equity curve that goes all over the place because the markets are obviously very, very volatile intraday and the opens are very, very random. And again, this is one of the reasons I kind of wanted this site built. You can confirm that for yourself. What happens intraday every day is random. There are no 2 days, and this is something I got AI to do a while ago. I got AI to analyze the open of thousands of opens on. I did get it to do FX as well, indices and FX pairs. I'm pretty sure. I can't remember, but I asked it to look for price patterns and identify price patterns. And I wanted it to find me 2 days that were identical. And I asked it to find me two 4-hour sessions, I think it was, that were identical on a 15-minute time frame. So basically what I was saying was, go and find me patterns you can find repeating. There aren't any, was the answer. And I said, rubbish. There are. And he was like, no, there aren't. What I actually asked him to do without thinking about it was to find me exactly the same pattern unfolding every day, candle by candle. It's never happened. Every single day on every single index is different. There has never been 2 days which have the same 5-minute candle followed by the 5-minute candle and the 5-minute candle after those being the same. There's never a period of 3 candles which are identical. Yeah, the market is completely different and random every day, which means that when you take intraday trades, you are driven financially by how the market unfolds on that day. So you have breakout trades, you have trend trades, and you have mean reversion trades. If you wake up in the morning and you focus on mean reversion trades, when the market goes into a trend, you will lose. If you wake up in the morning and you look like it's going to trend and you take trend trades and what it does is it goes sideways all day, you will lose, right? So all you can do as a trader on intraday low time frames is wrap risk reward around price movement and make sure that when you set that and you set that, that is higher than that. How the day unfolds is what is in charge of your end of day, end of week, end of month balance. You can't control the market. And what people try to do is forecast where the market's going to go without thinking about it. You go, I'm getting in long here because there's a 3-bar reversal. I need a 3-to-1 risk reward ratio. When you actually look at what you can achieve with a 3-to-1 risk reward ratio, what you're asking it to do is move 150% of its average daily range. It's not going to do that. So intraday, you are open to the elements, if you like, which is why my P&L on intraday trading is like this. Horrible. Position trading goes like that. But I can't make 10 to 15% weekly on position trading. You can on intraday trading by taking high risk. If you look at what the AI has done, he's made a 0.41. So what's today? The 27th. He hasn't taken any trades today. Look, on the NASDAQ. No trades today on the US markets at all. Oh, yeah, no, there is. Oh, yes, 3 losers, look, today. But if you look at what he had done before he lost that, he's still on 9.16. Yeah, these big winners are what pay you. So when you're trading intraday, the way that you make money intraday is by getting into a trade that works with your idea and then adding size into it and exponentially growing those winning trades. So what you end up with is the death by 1,000 cuts. Yeah, so you get it wrong most of the time. But when you get it right, you get more size on, which pays for the ones that go wrong. So you end up with a P&L that goes like that. Yeah, you get these big winners. But those big winners are there because you pile size on. And it's not for everybody. And it's really not for me. I don't enjoy it anywhere near as much as I do position trading. But depending on the account size you've got to play with, it's a necessity. And this is why nobody wins at prop. Yeah, because prop, you will always hit that losing run because the market conditions are wrong. If you are a mean reversion trader and you've got an amazing Bollinger Band strategy, brilliant if the market does that, and brilliant if the market does that. If the market goes parabolic for 3 days solid on the indices, you will lose 10% of your account. Yeah, people go, the strategy doesn't work anymore. No, the market condition has changed. It was like that and it was working. Now it's like that and it's not working because you're trying to mean revert a parabolic trend. Yeah. You can't know every day whether we're going to go into a parabolic trend or whether we're going to be in mean reversion and rotation. Yeah, because you can't see the future. With position trading, it doesn't matter. It really doesn't matter what the future holds because as long as the market moves, we have a way to extract money out of that movement. We are just scaling in and out of market cycles. The only time we lose is where we get parabolic moves that are abnormal. We can't see the future. So those ones we pull. And position trading profits come down to how many squeezes you get through the year. On a bad year with multiple squeezes, don't break even. I make money, but I don't make anywhere near as much as if we have 2 to 3 squeezes a year, which you can generate easily 10 to 15% out of. Intraday, it's different. So if you do both, you have both bites of the cherry. Yeah. But intraday, the psychology kills everybody. This is where everybody goes wrong intraday. And this is why there's not masses of people that like to do it. Everyone goes onto YouTube and says they can do it, but you can't. Yeah. You get chopped around a lot. Yeah. You're going to get a lot of losing trades, but you're going to get a lot of winning trades. Yeah. And it's just repeating the cycle. So, you know, the Dow today has won. The Nasdaq today is still going. The DAX today has lost. Yeah. So overall today we're down. Yesterday we're up massively. The day before we're up massively. But I'm not in control of it. The strategy works long term, intraday, but it doesn't work intra-week. I have weeks where we lose. We have multiple weeks where we've lost. But long term it wins. And that's what the difficulty is with most people, which is why this, I think, will be really useful, because intraday we will only make decisions based on positive expectancy with a positive risk reward profile, which means you are only ever able to take trades that have a possibility of making money long term. That's where if everyone goes wrong. So you suddenly go, oh, do you know what? 1.5 to 1 isn't going to cut it. I'm going to go for 1 to 1 risk reward ratios. And suddenly you start making money and you see your P&L do that. What you don't realize is it's a zero sum game, and your P&L will do that. And it will end up back where it started with a 1 to 1 risk reward ratio, because by luck and averages, you will get a 50% strike rate at the end of the year. But you want to feel good. Yeah. So what you do is you do it because it feels good. And then when it starts to feel bad, you go tilt. Yeah. That's why intraday trading is so difficult for people, because they can't see the long-term gain and outcome, which is where backtesting comes in, which is why I have a section on system parameter permutation testing and backtesting. As well as giving yourself confidence in the strategy, you can show yourself how that strategy is going to play out. So when you see a strategy that goes from there to there, but the way that it gets there is like that, yeah, you know that when you get 20 trades in a row that lose, it's totally normal and you accept it, because you know that you're going to get 20 trades in a row that win with 2R instead of 1R losses. Yeah. But until you've back tested it and you've seen the outcome and the way that you got there, unless you do this process, you will never make it in trading, because you won't ever see how trading works. And that's why I built this page on the website. Yeah, to demonstrate to people how the market will make you money. But every time you take a trade with a strategy, you'll get a different equity curve. The end result is the same, but you're going to get a losing run of 8 trades. Next week, you'll get a losing run of 10 trades. Next week, you get a losing run of 8 trades, 7 trades, 11 trades. Yeah, it's going to change every week. But you will get there, because you know that every time you take some losers, your winners will come. And the lower that gets and the higher that gets, the more aggressive those dips can become. Yeah. If you started trading a strategy there and you traded it all the way down to there, you would have lost over 3 grand. Yeah. On 78 to 90, 12 trades. So 12 trades in a row, losing you 3 grand. Good strategy or not? Brilliant strategy. But the week that you started trading it, it looked terrible. This is what intraday does to you. You get beaten up a lot, death by 1,000 cuts. Position trading, you don't see this. You see a clean equity curve, because our strike rate in position trading is 80%. Yeah, that's what our position trading equity curves look like. Yeah, no psychological problems there. No issues. Completely different strategies. But running that type of strategy with a different type of strategy with another different type of strategy will mean that you will always be in the money somewhere, which is what this is all about. It's about getting an end goal of extracting cash out of the market. But if you're psychologically not made up for this, don't do it. It's horrible. Yeah. Look at this morning. Yeah, DAX. Went short, stopped out. Went long, stopped out. Moved up 1R, should have taken it, but didn't. Stopped out. Now it's gone short again. If you took the short there, you stopped out. Horrible market. If you sold the highs because you're a mean reversion trader trading a Bollinger Band extension, which happened there, well done. If you're a Bollinger Band trader and you took the mean reversion there because we had the extension, well done. But I'm not. I'm a breakout trader. Yeah. So should I become a Bollinger Band trader? Yes. Then what happens? The market goes sideways for the next month. You don't make any money. I'll chuck that strategy and I'll go and find something else. You just hop and hop and hop and hop. And that's because everybody is trying to make money on this time frame. It's algorithmic chop. There's very few edges that exist. Market's going mental. Pound New Zealand 125. Oh my God. Happened to the pound. Something's just happened to the pound. Oh, we've just pulled out of Iran. Okay, so Britain has just temporarily withdrawn its staff from Iran due to the security situation. We are invading Iran this weekend. Not us. Well, I don't know, maybe us. But Swiss franc. That is definitely that safe haven run. US Secretary of State will travel to Israel from March the 2nd to the 3rd. Discuss Iran, Lebanon, and Gaza. Sounds like it's kicking off, doesn't it? Position trading really resonates. Yeah, it will do. Position trading resonates with everybody because it removes psychology. Psychology is why you fail. All traders fail because of psychology. They get beaten up. And when you remove that, that's why it works. It has pitfalls though. Yeah, we get stuck in squeezes. Pound New Zealand being one of them. And we are 125 ADR now. Wow, that's really tanking. They really don't like that news of us pulling out of Iran, do they? But why would that tank the pound? It's not going to affect our currency, the fact that we've decided to pull staff out. Well, unless there's something else happening that I don't know about. But anyway. Nick showed that trading stop is not a good thing to do. Are you still using it in ORB? Yeah, I know trading stops are not a good thing to use if you are taking profit. If you are not taking profit, right? So ORB, right? That one's not in profit, is it? That one was in profit. Okay, so look at this here, yeah? So that was our break short. That was our target. When we hit target, we trailed, yeah? We don't trail until we've taken a partial profit. However, 90% of the time, you will be better off taking the full amount there than trailing. Okay, so mathematically, yes, it is worse to do taking a trailing stop, using a trailing stop. You're better off taking all the profit there. Yeah, we did the maths on it, and actually having a target of 1 to 3 mathematically makes more money than a target of 1 to 2 with a trailer. In fact, they're very similar. It's nicer to have a trailer because psychologically, when you get the 10R days and get nothing out of it, it's painful. Yeah. So when you get a 10R day and you take 2R, you kick yourself. When you take 2R and leave 25% trailing to 10R, it makes you happy. It pushes a pleasure sensor. The difference is minimal, but it is mathematically better. So I wouldn't trail before any money's been banked. Because if you do that, you will get, right. So let's say, for example, we set a 1 to 3 here. Yeah. And our target was down here somewhere, right? What's happened is we've moved down to R and we go, brilliant, let's lock it in. What happens is it comes and hits our target, gives us a break even, and then goes straight down to target. So we don't get the 3R and we do get the break even. That is why trailing stops don't work, because the way that market structure works is we enter on momentum, it pulls back into propulsion and then continues. If we enter on propulsion, momentum, and then moves down and we break even, we are placing our stop loss at exactly where the market is going to add its size. That's why trailing stops don't work, because of market structure. I don't care how many people tell me they're good, they're not. I've never used them in normal trading. I have used them. I haven't used them for many, many years. And I will only use them when there's a partial been taken, or I really don't have confidence in the trade. So if I see a trade unfold, for example, if I see this thing break long, yeah, and then I see that, followed by an inside bar, followed by that, followed by that, followed by that, I will trail to break even, because that is not working, is it? So I will use them discretionarily in trading, because I see the market is just not going what I want it to do. That's the only time I would use a trailer. But you will always get the trail. Whenever you put trading, the whole point of a trading stop is to lock in profit, not to break even. That's what everybody uses trading stops for. And the trading stop here, look at what I took and look at what I took on the second half. I could have taken that much. So I've missed that much profit because I trailed it. It's totally right. Trading stops are terrible. I did do there's an analysis somewhere where he gave me a spreadsheet. In fact, I did that in Claude. I got a spreadsheet for it. I'm not psychologically built to trade intraday. I prefer longer trades, hours to days. Yeah. You'll make more money as well. So I've known a lot of traders over the years. I know very, very few traders that make money on any time frame lower than the hourly time frame. Hourly is you're splitting the entire day up into 24 bars, 24 sections of analysis. On a stock index, you're splitting the day up into 8 hours of analysis, 8 bars. And that is enough to give you information as to what the market is doing with a bigger degree of certainty than any other time frame below it. So this is where the money is made, because you see more of the market movement. You see more of the support, more of the resistance. You know more where price is likely to move from and to. Intraday, you are seeing messy movement. Banks and institutions dumping large things into the market. You will always make money on the hourly time frames. If you're going to develop strategies, never go below 5 minutes. The only reason I trade intraday with ORB and strategies based around that, and probably more with statistical analysis now that I've got somebody to help me with it, is you know when the move's coming. So the only ways you can really make money out of the market is by preempting market movement, being an insider trader, in stocks, or having an insider in government, so that you know when the moves are coming and where it's going, or being able to time when a move is likely to happen and have an inkling of direction. That's why the opening range breakout strategy and strategies based around stock index opens and intraday strategies on stock indices work, because we know when it's coming. 9:30 a.m. US, 8 a.m. UK. That's when it's going to hit. And we know what it's going to do. And now, thanks to Nix, we know even more what it's likely to do. So it gives us even more confidence in taking those trades. And knowing that there is a 60% probability of that happening and a 40% probability of that happening means if I take that trade and that happens, I'm comfortable with it because I was expecting it 4 out of 10, I'm expecting that to happen. As long as it doesn't happen 8 out of 10 when I take one of these, I'm all right with that because I know I've got the mathematics to back it up. And that's what backtesting does, is it gives you the statistical advantage in you've seen the strategy play out and you've seen the hell you're going to go through. ORB, I've seen stagnation periods of 3 months where it hasn't made money. So when I sit here and trade ORB for 6 weeks and it's not making money, it's breaking even or it's in a small loss, I'm comfortable because I know it can last 3 months. But I've also seen the run-ups where it does 20, 25% a month. And they come as well. Yeah. So you know how it's going to unfold. When the markets go parabolic and the NASDAQ takes off, you will make money every day for weeks. But you have to sit through the crap while the market's waiting for the earnings to come out to drive it. And sometimes it's when the earnings come out, it goes flat. There is no cycle. Yeah. So you see what happens. You've got to visually see these P&Ls, and that's where backtesting helps. Go in the position trade. You put the position trader EA in the backtester, run it, and get a visual idea of what the P&L looks like. That's what you're going to expect. When you see something open and then it shuts it 8 weeks later, you are in a squeeze for 2 months. It's coming. Yeah. Prepare yourself. It's going to happen. So know how to handle it. And that's what it's all about. Trading is about accepting the outcome is random, but having statistical advantage or a way to extract money from what is going to happen on a regular basis. That's what both of these do, basically. Everybody else out there that's got an RSI alongside a stochastic, that's got this indicator and that indicator, as well as another indicator and a dashboard on the left-hand side of their charts, they've just got a load of information of what's happened in the past. It will not help them make any decisions on which way the market's going next. No one knows. The banks don't know. So how do we know? You can't. So you just have to use maths. That's where everyone goes wrong. Unfortunately, I went wrong like that for years. Everybody does. Because you just follow the crowd, and the crowd's always wrong. UK supporting US in Iran war. Yeah. Okay. Or was it the UK didn't allow us to use airports? Didn't allow to use airports. So basically, we've had American jets over in the UK for weeks now, using our air bases. The US were asking permission. We were reluctant, but we let them. So basically, they're using us as a launch pad because obviously the distance is less. And obviously, they've got bases here. We've got bases in the UK, which are US bases, and likewise. So, yeah, we've known it's building up, which is why I said, there's a likelihood it's going to happen because we're now seeing jets in Israel as well, probably foreign jets as well. So it does look like it's happening. And the fact that we're pulling staff out means it's imminent. Yeah, you don't just pull your staff out and shut down your operations in another country without good reason. So Iran will know it's on its way. I'm not quite sure why that is quite so bad for the pound. And the fact that, if you look at the US dollar, so the market is tanking all participants in the conflict by the look of things, aren't they? Yen is holding up. Who knows? Based on correlation analysis on position trading, you still trade limited basket of pairs. Yeah. So position trading, I was still running. Well, the MT5 that I was running was trying to do correlation manually, automatically, and it didn't work out. So yeah, still running correlation based on these basket settings in here. So all Forex pairs, whoops. And daily correlation. Well, that's too low. So 60 to 70% correlation. I prefer sort of 60, 65% correlation. So there you go. There's a basket there. And obviously you can take out symbols that are no good. So if I'm in a New Zealand dollar Swiss trade, I can take that out of the equation and then it will tell me what I can and can't trade. So still using this. But again, with a pinch of salt, at the minute, there's an argument, I think, for using all pairs with very low risk because of the correlation now. We're seeing a lot of correlation, a lot more correlation, I think, than we have in the past. And a lot of that, I think, is to do with the fact that the yen is strengthening and we're not saying the carry trade as much. So we're getting other things moving together. We're also getting things diversifying, aren't we? The US and the CAD don't move together as much as they used to because the trade partnership's broken down, as it has with Europe. So things change. When things change, you have to adjust. And I think using lower risk across more symbols is probably a better approach now because you've got more chance of making money more often, but less of it. And it means you can also survive squeezes longer as well. I think it's Michael. I don't think he's in it at the moment, but I think it's Michael that is in 28 pairs, but his risk is something like 0.01% on the initial. And he uses wider space. He doesn't use lot increment until he's in 5 trades, I think. You put it in the members. Did you put it in the members group or in somewhere else? Might have been putting it. I think he might have put it in the position trading somewhere. He put what he does, but yeah, there's absolutely nothing wrong with that. In the fact that he's basically taking more risk after more trades. So the logic is sound, and it's something I think is worth testing actually with an EA. So when you get into a trade, I've tested similar things in the past, not quite the way that's done though, but so taking your trades at normal risk until you get to a certain point. So when the market has moved, like that would be like 2.5 ADR maybe against you or 2 ADR against you, then start to 1.3 increment or whatever you want to increment by, but keep these at the same lot size. Yeah, which means that your average will always be bang in the middle. But when you start getting squeezed, that is the time to increase, which means that that reduces your drawdown long term. So you survive longer before you have to pull the plug or do aggressive drawdown control. So there is an advantage to doing that. But it needs testing as to whether it's better than using a normal increment and the usual 3 to 4 trades, which is a standard position trade 80% of the time. Yeah, 80% of the time we get into a position, we take 3 to 4 trades and before we get out with a 1 ADR pullback. We'd have to test whether that is still possible, a 1 ADR pullback exit, because I get the feeling that your average will be further away than 1 ADR, which means that on a normal market structure move, you may not get the exit there. So you'd need a 61.8 retracement to get exit, which obviously still happens, but less often than a 50% retracement. So again, it's all maths. Everything in trading is to do with mathematics. Fibonacci is maths. Yeah. Retracements are percentages. Everything is working in cycles. Yeah. So everything in trading is all about finding mathematical edges that play out with probabilities. Yeah. And that's what position trading does. It measures market movement and it measures market pullback. It finds the averages and it scales in and out of those. Yeah, that's what position trading is, which is why we use 3/4 of an ADR as an average scaling, and we scale up by 1.2 or 1.3 increments when we get in, because we know that the average squeeze, which will take us to 6 to 8 trades, will retrace by enough if we use a 1.3 multiplier to get an exit on 1 ADR. Maths. When we get further than that, or we do it slightly wrong, that's when problems occur. So if we cannot take a trade at 3/4 of an ADR because the market pushes 1.5 ADR before a signal, that creates a problem. That's what we have to deal with manually. And there isn't a way to fix it because it's an anomaly. So we just have to deal with it. Yeah. And that's where you come in and EAs can't really take over. There are ways EAs can be programmed to do all sorts of stuff, but there is no two scenarios that are the same. So you have to kind of bend a little, if you like. I have 70 correlated. I have a 70 correlated basket with a lower risk of 0.175. Yeah. Yep. Perfect. The lower the risk, the better. It's all about making money at the end of the day. And if you're happy to make 3 to 5% a month on average with a lower risk, you will do that. And this is the thing: if you've got $100,000 account to trade with, absolutely right to do that. Yeah, you'll find it making you about 50 to 80 grand a year instead of potentially 100 to 150 grand a year. But you will be safer and you will last a lot longer in squeezes than I would, for example. So, it's about aggression. Yeah. If I had $1 million account to trade with, I would use a 0.05 or a 0.1 maximum risk per entry. And I would never need to touch it. You can backtest this, stick $1 million in an account and use a 0.1 backtest, percent risk per trade. Doesn't matter what you set that up as, it will survive because the market's never squeezed far enough to not get you out of it. Apart from probably gold recently. Other than that, you won't find an exit. Yeah. Just 1 year of compounding with 100K. Yeah. You can compound, obviously. Compounding means you can't withdraw. So again, all these people have got these wonderful strategies which make a lot of money, but they only make a lot of money because you never withdraw money. I don't know how you're paying your mortgage, but I need money. So my bank account goes up and down and up and down. Yeah. I have to withdraw. So 100K doesn't turn into 200K. It turns into 120 maybe because you have to pull out. Compounding is great for savings and investments, but for everyday trading, you can't compound. Yeah, with a small account, a 10 grand account that's being traded intraday, when it trades up to 2K, it gets pulled out and I'm back to 10 again. It goes like that. It doesn't grow because I need the money. Can't do that. So that's the bit that they don't show you, isn't it, on YouTube? If they showed you that, it wouldn't do what it did in the equity curve. All the back tests you see, you get these beautiful backtest equity curves and some of these EAs on the marketplace. They're all curve fit. They never last. But it also risks 1% a trade. So you start with a 10K account, risking $100. By the time you're at 20K, you're risking $200, which means the equity curve gets exponentially larger. So the equity curve ends up looking like that. You've seen these P&Ls before, yeah? Where the P&L gets really slow. It takes about a year. Then all of a sudden it takes off. Of course it does. You're risking 100 down here. Now you're risking 25K. Of course it's going to take off like that. But you won't be doing that. Number one, your broker won't allow the lot size. Number two, there's no way on God's earth you start at $100 and you're now happy to risk 25K. As soon as that goes into drawdown by 15K, you're panicking. That isn't doable by a human being. Not with any sense, it isn't anyway. Yeah, they're all smoke and mirrors. 90% of the stuff you see on MQL5 Marketplace is rubbish. It's all rubbish. Anyway, we've been waffling on for 2.5 hours, which is way longer than normal. So I'm going to let you go. Surprised you're still here. Probably you're awake. I don't know. Anyway. Go and have a play with it, EdgeStat Pro. If you see anything on it that you think that's just doesn't add up or something, just let me know. I've been working on this with Nix, and it's got to the point where I've got to really spend a lot of time figuring out a lot of stuff with it to take it forward, because I just don't trust him enough to do everything himself, although he's done an amazing job. And I'm seeing a lot of edges here, and I've traded a lot of these edges, and they are actually working. Like today's, I took the reason, whether it's right or wrong, I took that long there because the stats told me to take that long. So I took it and it worked. Whether the statistics are 100% right or not, I don't think it matters. It helps you make decisions based on what is likely to happen. And really, where it's likely to go, I think, is the most important thing. It told me to take a 1-to-1 because the strike rate was very high. So I took a 1-to-1. I didn't target the previous close because the probabilities were lower. And it hasn't hit that yet. So it's making me make decisions based on what it has done in the past. Yeah. So it's doing its job. If it's psychologically preparing you for failure or success, that's half the battle, isn't it? So I think it's got a lot of legs. And I'm going to leave it up there for free for people to use, and we'll see what feedback it gets. But you know, there's probably other versions of this out there that are possibly better. I'd have to have a look, but you know, I know there's other people now. I've seen what Tom's posted. I know that screenshot. It looks very much like mine. So he's obviously doing something very similar. Yeah, he's just posted another one of trade performance. So something else is going on now. I'd like to see what he's doing. That'd be interesting. But anyway, I'll let you go. Have a good weekend. I'll be back on Monday morning. We'll look at the news next week, see what's coming up. We'll see what's happened over the weekend. Be aware if it does kick off in Iran, we might get some big moves. Make sure you got stops in place on your aggressives. I will have to put stops in place on mine because that I haven't got stops on because you can't leave them open in case it does go parabolic. The oil price, I was just going to say the oil price is likely to go through the roof because conflict is good for oil. Supply and demand. The demand goes up, the supply hasn't changed, so oil price goes through the roof. So look at the last time when we had Russia invade Ukraine. Yeah. If we suddenly invade Iran and it turns into a longer scale than a 2 to 3 day conflict, scrabble or scuffle, whatever, which is what happened last time, you're going to see a bigger move. So long oil isn't a bad play, but you're going to need a stop loss. So it's just a normal risk reward trade at the end of the day, but it's worth a long. Right, so I'll be back on Monday. We'll have a look at it. Okay, so have a good weekend. Anything you need, post in the group. Other than that, I'll see you next week. Have a good one.